If you have $1,200,000 sitting in your traditional IRA and you are living a comfortable, frugal life on $40,000 a year, you probably think you have already won the retirement game. You are sitting in the 12% tax bracket. Your spending is low. You feel safe. Under the tax rules in effect right now, that $1,200,000 is not a safety net. It is a tax bomb set to go off the moment you turn 75. Here is the trap almost nobody explains correctly. The Roth or die crowd tells you to convert everything right now, no matter the cost. The convert nothing crowd tells you to leave it alone and let it ride. Both sides are quietly costing frugal savers over $150,000 in taxes and Medicare surcharges they never had to pay because both sides ignore something worth calling the RMD Tax Bubble. Today, I want to walk you through a third way. It is a partial conversion strategy built to protect your low-tax lifestyle, not blow it up. We are going to look at the real math behind how a person spending just $40,000 a year can suddenly get pushed into a 22% bracket, plus Medicare surcharges stacked on top of it. Then I will give you a simple 3-question test to figure out exactly where you stand. If you built a comfortable retirement by saving aggressively in your 401k, and you are only now realizing that success came with its own tax headache, stick around. Subscribe to Wes Investor. This channel exists for the specific math that keeps the tax code from quietly taking a bigger slice of the retirement you spent 30 years building. Here is the part almost every guide gets backwards. The tax code does not care what you spend. It cares about what you are forced to take out. That is the whole mechanism behind required minimum distributions. Once you turn 75, the government requires you to start pulling money out of your traditional IRA, whether you need it or not. The amount is not based on your grocery bill or your mortgage. It is based on your account balance and your age, using a formula the IRS calls the Uniform Lifetime Table. Let's put a real number on it. A $1,200,000 IRA at age 75 uses a divisor of 24.6. Divide the two and your first required withdrawal comes out to roughly $48,780. That check gets mailed to you whether you want it or not, and it counts as taxable income the moment it lands. And that number does not even include your Social Security check yet. Add Social Security to the picture, and the stack gets bigger fast. Say your Social Security check runs $30,000 a year, boosted by the 2.8% cost of living increase that took effect this year. Add the $48,780 RMD, and your gross income for the year jumps to roughly $78,780. That number matters because of where it lands. A frugal retiree who has spent years comfortably inside the 12% bracket suddenly gets pushed into the 22% bracket, and it happens automatically, with no purchase and no lifestyle change. On top of that, once income crosses certain thresholds, up to 85% of your Social Security benefit itself becomes taxable. People call this the tax torpedo, and it is one of the least understood traps in retirement. I have watched this catch smart, careful savers off guard more times than I can count. They did everything the personal finance world told them to do for 30 years. They maxed out contributions. They avoided unnecessary debt, and the tax code still found a way to take a bigger bite than they ever expected. This is not a coincidence, and it is not unfair either. It is simply the tax bill you deferred for 30 years finally coming due. All at once, on the government's schedule instead of yours. You got the deduction back when you were working. Someone still owes the tax later, and later just arrived all at once. But the income tax bracket is only half of the story. There is a second tax hiding inside this bubble, one that never shows up on your tax return at all. It hits your Social Security check directly, and it gets triggered by the very conversions people assume will save them money. That is where this gets interesting. So how do you actually figure out whether this bubble applies to you without hiring someone and paying for a complicated plan? I use a simple 3-question test. Question 1. Is your total pre-tax balance under $500,000 and you have no pension? If yes, in most cases the answer is straightforward. Fill up the 12% bracket with conversions each year and stop there. You do not need anything more complicated than that. Question 2. Will your future RMDs end up larger than what you actually plan to spend? This is the bubble test. If your projected RMD at 75 is bigger than your real lifestyle spending, that gap is pure excess income. The tax code is going to tax at a rate you never chose, whether you need the money or not. Question 3. Are you within about $20,000 of an IRMAA tier? This one catches people off guard more than the first two combined, and we will spend real time on it in a moment. I used to think everyone needed an elaborate financial plan full of complicated projections and simulations to make this decision correctly. I was wrong. For most of you, 80% of the benefit comes from doing one simple thing. Do not fall off the cliff into the next tax bracket. Here is what that looks like with real numbers. Say you convert $25,000 from your traditional IRA to a Roth IRA this year. If that conversion keeps your total income $1 under $109,000 as a single filer, or $218,000 filing jointly, you pay ordinary income tax on that $25,000, and nothing else changes. Stay under the line, and this is a clean, controlled, entirely predictable tax payment. Cross that line by even $1, and it is a completely different story. You do not just owe slightly more tax. Your Medicare premium jumps into an entirely new bracket, and it stays there for a full year, sometimes catching you 2 years later, because Medicare looks back at your income from 2 years before. None of this requires anything complicated. It requires knowing your number, checking it once a year when you have a clear picture of your total income, and staying disciplined about not converting more than the room you actually have. That is the entire system. It is not clever. It works year after year because it is built around your actual tax brackets instead of a general rule of thumb someone read online. A simple way to check where you actually stand is to gather every income source for the year, your Social Security statement, your pension if you have one, and any distributions already taken, and add them up before you touch the conversion amount. That one number tells you exactly how much room you have left before the next tier kicks in. We will get into exactly how much that cliff costs in a moment, because the number surprises almost everyone the first time they see it. That cliff costs more than most people expect. Medicare Part B in 2026 has a standard monthly premium of $202.90 per person. That is the starting point everyone pays. The moment your income crosses the IRMAA threshold, that premium does not creep up gradually. It jumps to the next tier immediately, adding roughly $81 a month per person to your Part B premium alone, plus an added charge on your Part D drug plan. For a married couple, that is money coming out of both spouses' checks every month for a full year. Think of it like your car insurance premium jumping a full tier because of one speeding ticket. Nothing else about you changed, but the number attached to your name did, and now you are paying the new rate for the next 12 months, no matter what. Here is a piece of good news almost nobody factors into their conversion math. Current law gives everyone 65 and older an extra $6,000 deduction per person, on top of the standard deduction through tax year 2028. For a married couple where both spouses are 65 or older, that is $12,000 of income you can shelter before you owe a dime of federal tax on it. This deduction comes from the One Big Beautiful Bill Act, and under current law it only runs through 2028, so it is worth using deliberately while it lasts. It does start phasing out once your income passes $75,000 single, or $150,000 filing jointly, so it is not unlimited, but for a lot of frugal retirees converting modest amounts each year, it covers real ground. Picture two people with the exact same $1,200,000 IRA. The first person converts $50,000 in 1 year without checking any of this first. They pay the tax bill, and 2 years later their Medicare premium jumps because nobody warned them. They had crossed the IRMAA line. The second person uses the same $6,000 deduction to shelter part of that conversion from tax, and stops the conversion amount short of the IRMAA threshold on purpose. They start with the exact same balance and the exact same age. The only difference is that one of them planned around the cliff, and the other one did not know it existed. That difference in awareness is worth real money, year after year. But there is a bigger reason to get this right than protecting your own Medicare premium. What if the real risk here is not your tax bill at all? What if it is the one you are about to leave behind for your spouse? This is the part of the conversation almost nobody has, because it means imagining your spouse without you. Picture a $1 million IRA left behind to a surviving spouse. While you were both alive, you filed taxes together, married filing jointly, with 2 full sets of tax brackets to spread income across. The year after one spouse passes away, the survivor moves to filing as a single person. The tax brackets essentially cut in half. The RMD does not shrink. It stays exactly the same size, calculated off the same balance, now taxed inside brackets built for one income instead of 2. That gap is what I call the widow's tax, and it can be one of the most expensive surprises in retirement, hitting at the exact moment someone is already dealing with the loss of a partner. The dollars themselves do not change at all. It is the same $1 million balance, still generating the same required withdrawal every year. What changes is the size of the bracket that withdrawal has to fit inside, and a bracket built for one person is a lot narrower than a bracket built for 2. This is not a rare edge case either. Most married couples eventually become single households one way or another, simply because very few couples pass away on the same day. If most of your savings sit in one large traditional IRA, the odds are high that a version of this bill lands on whichever one of you is left. Here is why the timing matters. According to Social Security's own actuarial data, a 65-year-old man today can expect to live to around 84, and a 65-year-old woman to around 87. That 3-year gap is not a footnote. It is exactly the window where the widow's tax quietly does the most damage, because the surviving spouse is usually managing that large IRA alone, inside a much smaller set of tax brackets. There is a way to soften this in advance. Instead of waiting and letting the whole balance dump onto one surviving spouse later, you convert pieces of it now, while you can still use both of your tax brackets together. Think of it as prepaying part of the tax bill at today's joint rates, instead of leaving your spouse to pay it later at single rates. I know the next thought that comes up for a lot of people, because I have watched this happen more than once. It feels wrong to hand money over early, on purpose, before you are required to. That feeling is completely normal. It is also a psychological barrier worth pushing past, and that is exactly what we need to talk about next. So why do so many people who understand this math still do nothing about it? Behavioral economists call it loss aversion, and it explains a lot of retirement behavior. Watching $20,000 leave your bank account today to pay a conversion tax bill feels far more painful than losing $100,000 to invisible RMD taxes 10 years from now, even though the second number is 5 times bigger. The pain today is loud. The bigger loss later is quiet, spread out, and easy to ignore. If that describes you, there is nothing wrong with you. You spent 30 years being trained to defer taxes every single year through your 401k. Flipping that instinct around and choosing to pay some tax voluntarily today goes against every habit you built during your working years. That discomfort is normal. It does not mean you are making a mistake. One shift that helps is changing what you call the payment in your own head. Instead of thinking of it as a tax bill, think of it as buying an insurance policy for the version of you that is 80 years old, one that guarantees a chunk of your income arrives tax-free no matter what future tax rates look like. The other practical piece is how you actually pay for it. If you are already 75 or older and taking RMDs, you can often use part of that required distribution, combined with the extra room from the $6,000 senior deduction, to cover the tax bill without touching your other investments or selling anything you would rather leave alone. None of this has to happen in one single year either. Spreading conversions out over several years, in smaller pieces, tends to feel far less painful than doing it all at once, and it keeps you from accidentally pushing yourself into a higher bracket in any single year. Let's bring this back together. A Roth conversion is not a religion, and it is not an all-or-nothing decision either. It is one tool used to smooth out the RMD tax bubble before it smooths you out first. Run the 3-question test. Check your balance against the $500,000 line. Test whether your future RMD outgrows your real spending. Watch the IRMAA cliff like it can actually bite you, because it can. If this helped you see past the Roth or die noise and gave you something practical to actually use, hit subscribe. We are here to help you keep more of what you spent a lifetime building. Retirement was never really about how much you made. It is about how much you actually keep. I will see you in the next one.